Today, we're going to go over conventional loans. What is a conventional loan? Well, for all intents and purposes, it's kind of the cream of the crop. It's the loan structure that everybody knows about, and it is not backed by a government entity. So, like FHA, USDA loans, and VA loans are backed by the government. Conventional loans are backed by the private sector. So they kind of play to a different set of rules, as you'll see here as we go through. So conventional loans can be adjustable rate loans, or they can be fixed rate loans. Obviously, with the adjustable rate mortgages, your rate can adjust throughout the life of the loan. In general, borrowers choose conventional mortgages because of better rates and more creative down payment options that are available in conventional rates. So most of the time, your clients, or you may have heard, you hear about 20% down. This is a misconception that you need 20% down to get a mortgage. That kind of comes around this next topic, which is private mortgage insurance. So if you put down less than 20%, or you're at a less than 20% loan to value in your conventional mortgage, you will be paying private mortgage insurance, which is going to cost you some extra money per month. The reason for the private mortgage insurance is in case you default on the loan, there's a pool of money that takes care of that. That works in a great market, but certainly doesn't work in like the meltdown of 2008 when everybody is losing their mortgage at the same time. We just don't have the money to cover all of those losses. So traditionally, or generally speaking, you need a roughly a 620 credit score for a conventional loan, and your DTI must not exceed 43%. This is a little bit higher than your government-backed loans, and this is why the conventional is the cream of the crop. Some lenders will bend these rules for conventional loans, and they will not be able to sell those on the market. So generally speaking, they make a loan and they sell it so that they get the money back so that they can make another loan. Well, if they don't fall into this category with their conventional loan, they're not going to be able to sell that off to a government entity. Well, sometimes the conventional loan will meet the standard by a larger DTI, roughly around 50%. Some of these loans can still be sold on the market, even though some of the other portions of the conventional loan don't meet those standards. So each year, the Federal Housing Finance Agency sets limits on FHA loans, government-backed loans. Well, if the conventional loan, again, in order to conform or be a conforming loan for this conventional product, it has to meet those standards, again, to be sold off to those government entities. Another type of conventional loan is the jumbo loan. These limits go up above those government set marks that allow those loans to be sold in the marketplace. You're definitely going to need a much bigger down payment for this. Your credit requirements are going to be a lot more rigid, and these jumbo loan rates tend to be higher. So these are the loans. So we're roughly around $800,000 for FHA loan limits in high cost markets. These loans, jumbo loans, are going to be $1 million, $2 million, depending on the wholesaler or who's willing to take on these loans. We also, in the conventional range, have what's called a non-QM in the business, or non-qualified mortgage. These are the mortgages also that cannot be purchased by Fannie Mae or Freddie Mac and sold on the market for a multitude of reasons. Some that the DTI requirements are not met for the standard government loan, and the ability to repay guidelines established in 2008 are not met. So the ability to repay says that as a mortgage professional, we have to make sure that you are capable of paying that loan back, especially after the 2008 crisis. A non-QM loan could also be called a portfolio loan. If you have enough money, you're going to make these loans and keep them in your own portfolio as the lender or wholesaler and make the money off of the interest rates, but you still obviously will not get that large chunk of money back. So that lender or wholesaler must have a really large amount of cash to lend out on a continual basis. Conventional mortgage rates can be based on economic and market conditions, the overhead of the company, which changes daily. The rate you get will primarily be determined by your financial picture, and you're more likely to get good rates if you have good credit. So the bottom line is here that if you can't meet one standard of the conventional loan, there might be a little bit of you might need a little higher credit if you have less down. If you have less down, you might need you can get away with a lower credit score as well. So while some lenders are flexible, you usually need to compensate for that deficiency. So again, a little bit less credit, need a higher down payment for sure, or more income. So basically, a home loan is a very, very important financial decision. It can have a very big impact on your life and your overall wealth. Get the best advice from a mortgage professional. Talk to the right person. My name's Corey. Thank you for watching this video. Please leave any comments or questions below and like this video.